All right, guys. How's everything, guys? Thanks for joining. All right. Guys, I hope you had a good trading day today, and also last week. I know we missed a full week of community calls, and we missed a full week of one-on-one sessions with those who book sessions. So this week I will be more active again. Just last week I was very busy with something, but this week I'm back again. Today I actually seen a very nice trade on GU, which I will explain a little bit, because GU is actually a pair that I'm not really trading too much, but recently I noticed that the daily cycle and pretty much everything I use is working on it perfectly. I know GU is a good pair, so I do know it's good, but in my personal experience I haven't traded it almost never, to be honest. So now that will be a pair I will be looking at a little bit more. So I will explain what happened there. Because something I noticed actually on GU, that a lot of times the daily cycle does not care about the daily cycle. A lot of times, it does not care about the age or liquidity. What I notice a lot of times that it rather just follows the same direction as in London. So let's say, if London was bullish, then New York again bullish. So that's what I notice. So it does not care about the Asia range too much. So let's just look at that quickly. So GU. All right. So even from last week we had this short. This also turned out very nicely. We had this long. I just messed up the stop loss with this long. When I gave the signal, I didn't want to use the stop loss around this level. Guys, I always put it to the Fib 100 level, so that was a mistake by me. But other than that, the call was not bad. Then, if anybody remembers, I sent this ID of this order block on the 30-minute. See that? This order block aligning with the optimal trade entry, and this ID was also going very well. It came down all the way here, and today this ID which I sent for the long, I actually had a bias on it that it would go up, and the bias for it was this particular daily order block. Let me show you. So okay, this is not the best provider, I guess. So I actually was looking at it on IC markets. All right, it's right here. So it was a weekly bullish order book, right? So we got this candle, the last down close candle before the upside move. So overall, I had a bullish bias on it, that as we arrive into this area, I should just start looking for the patterns and the market to give us a long. So this gave me a bias that it would work out very well. This order block, also on the monthly. On the monthly, we had this swing low. If you guys check, so on the monthly, we could actually also implement the optimal trade entry. So we had this swing low, we had this swing high. And, obviously, if you look at it this way, we was also in this area where I wanted to take the long. So overall, I had a bullish bias on it, and that's why I was looking at the bias today. So this is what happened today. If we just zoom in. So this was the interesting candle for me. It's obviously a bullish order block. The market came back. And if you guys also check the daily cycle, we had the daily cycle going on to But it was kind of interesting today because I'm not really a big fan of taking these trades when the Asia is not swept. But in my backtesting and what I started to notice on GU, that a lot of times it does not care about the Asia range. So that's why I kept my long bias today. But eventually it took it out, right? So it just came back to take out these stops, which I also marked up, but initially the move was working out quite well. And this part, to the fair value gap in the market, it just filled the fair value gap and it started moving down. So, in a summary and quick explanation of today's trade, which I shared, this was the whole idea behind it. Because, on different pairs, I would always like to wait actually for this Asia low to break, to sweep the liquidity. So that's what I like the most. So let's say we would have the Asia and the liquidity, it should be swept. And that's when, you can confirm the direction if the Asia liquidity is swept. But, as I mentioned, this is something I notice on GU. So many times GU does not care about this. Also in the 1 year backtesting, where I went back one whole year, an entire year, and I backtested every single day on GU, like a week ago, I noticed this happening a lot of times too. So sometimes on GU, it doesn't matter if we sweep the low or we do not sweep the low, we just follow the same direction as in London. So, it's pretty simple. If London is bullish, you just wait for the pullback, the order block, and obviously New York should be bullish too. So this is what happened right there. All right. Guys, so this was GU, but in this lesson, I would like to mostly discuss and explain the no breakout structure entry, because I know that's something very interesting and I talk about it a lot. It happened quite a few times recently on Euro USD and US dollar Canadian dollar. It happened. So I can show you guys recent examples of how this thing works. But just as a quick context and explanation of when I'm using this no breakout structure entry. So let's move to the side. And let me just explain in a few words. So let's see. So, you guys already know that for myself, I have two confirmations. But, I never really explained how to use this. Just I said the idea that these patterns actually happen. But now I will explain the actual use of it and how to implement it in your trading. So these two movements in the market are actually my two confirmations for entries. So let's say if the market would sweep liquidity, you can imagine like give a liquidity sweep, or the market takes out a candle that's looking like an order block, but it fails and it sweeps liquidity on the left side. It takes out the smart money trap. Then this pattern or this one would happen a lot of times. So it happens a lot, especially it happens in a smart money reversal, which I will explain in a second. But this move on the left side, where we do not have any breakout structure, this usually happens when the market is in a strong impulsive move to the downside. So you can imagine this leg in the market would be a very strong impulsive move. It would also leave, let's say, fair value gap or imbalance somewhere here. And you want to imagine a large impulsive move, mostly bearish candles in this case. So obviously, if it's the opposite direction, then it would be all bullish candles. But this leg, you only want to see bearish candles in this example. So we do not have any structural point for this entry. And the reason why this works actually without using any typical break of structure in the market or any confirmation signaling you that the market will make a trend reversal. The reason why this works a lot of times, that when the market makes an impulsive move or it leaves fair value gap or imbalance behind, it's just a matter of time until it would fill in these gaps. So let's imagine this would be, like a fair value gap. And the market just comes down with a strong impulsive move to take out, let's say, double bottoms, something like that. And then you would see a pullback. And as you see the pullback, and from the pullback, you start seeing the retracement back around this discounted price level. So obviously, if I put on the GAN box, you want to see the market drop below the equilibrium to the discounted price. And that's where, you can place your fib level, and that's how you would take the trade. So, that's how this works actually. And something that's important about this, that it would usually happen actually.
A good 95.
Excuse me.
Why? Why?
Yes, excuse me. All right, I guess that wasn't meant for me. No problem. So this.
How are you? Is this a little late?
All right, the guy's muted, so we should be fine. So this would usually happen when the market is at an important level. It could be, let's say, smart money reversal of a market maker buy or sell model. It could be liquidity sweep. It could also be, let's say, order block. Like imagine the market arrives to a order block here. So that could also happen. It could also happen with optimal trade entry, like that. So you can imagine that this part would be the optimal trade entry. The market drops down with an impulsive move, and you would see this sort of no break of structure confirmation that you could be using for the entry. So this one is a little bit more different. It's a little bit easier, I guess, but the main idea that this would be a breaker in the market, and it's kind of looking like the simple break of structure trade, which is very popular. But the difference here that the market would not come down to an order block right there. So the market would just only arrive to the breaker right there. So this is how this one would look like. And, guys, I always say that if you have something looking like this, like let's say you have a breaker and you also got a OB, then you're going to obviously take the breaker. Because a lot of times, if you wait for the market to come down all the way to the order block, a lot of times you will miss the trade. So the best is always taking it from the breaker block right there. let's just look at a couple of real examples. I'm gonna show you guys this one first, where we have the impulsive, we have the pullback, and you take the trade. And something I would like to add to this one, that in order for this to work, you need a bias, right? So it's not enough to find these impulsive moves and imagine that the market will do this every single time. So this happens when we have something as a POI, point of interest, optimal trade entry, something like that, or even smart money reversal in the market. So what I mean by that, so let's say we would have this like let's imagine the market maker buy model. So let's imagine this model in the market. So this would be market maker buy model. I know this is taken from ICT. I actually use it a lot of times, so it's very useful, especially if you have the idea how to use this. But as the best explanation of this model, I know there's a couple of videos from ICT, but honestly, I haven't really felt that his explanation of this is the best. So I tried to explain this too. But if you want to find this model, then definitely look at the ICT YouTube channel. So this ID, the market maker models like sell model, buy model, is a whole idea of the market giving you a bias. So you would not use this for entries. It's only giving you a bias. Like let's say this would be a tool for you to determine the direction of the market. So let's say you would notice this market maker buy model, and we would be at this stage in the market, and you notice all of this happening. I will explain how this works, don't worry about it. But the way you would use this, let's say you notice these movements in the market and you would be at this stage, then you would know that you want to look for buying opportunities in the market. Also, if you would be at this stage, you still want to look at buying opportunities until the market clears this original consolidation. And you want to see the market, essentially trade above the original consolidation. So the way this works actually, that the market usually would create, let's imagine the market is creating a consolidation in this area. From the consolidation breaks out with an impulsive move. It creates another consolidation. And this second consolidation would offer you, let's say, a daily cycle setup. So imagine we have first this consolidation. We have an impulsive, then the market offers, let's say, a daily cycle. You take the daily cycle trade. The next day, we have an impulsive. We have sort of like an accumulation in the market and sort of, consolidation, the market starts accumulating. Then we have the final stage, which is the smart money reversal. And this is where this entry would happen. So this is the idea and this is the technique you would be using to take a smart money reversal trade. So at this point, you could be using either this setup or this setup. Okay, Leonardo, which time frame? So the time frame You know what, the time frame, I will show you an example of this, and you will see how this works. So it can happen on any time frame actually. So it's sort of like a multi-time frame thing. You know, it can happen on any time frame, to be honest. But let's say you would notice this whole thing on the 1 hour. You would just use this as the bias. But on a lower time frame, on let's say on the 15-minute, you could be taking trades, and you just use this buy model, the market maker buy model, as an ID, as a bias that eventually the market wants to trade above these buy stops. So eventually it want to take out this and consolidate above the original consolidation. So I know it's a lot of information, but once you know this, and once you are able to recognize this in the market, this will really help in your bias. So once the market arrives into the so-called smart money reversal, that's where you're going to use this pattern. So it can be either two patterns, this one, the breaker, or it can be this one. So usually the smart money reversal would be an impulsive move, which leaves sort of like an imbalance behind. So it would be a rapid move, because it's usually clearing out the liquidity at one point. So imagine this would be an old low. The market just takes out this old low. The smart money reversal, let's say, would be attacking this old low, and that's where this pattern would happen in the market. So it would be either, let me show you. So it would be either this one. Oops, mistake. Just a moment. So it would be either this one, or it could be this one. So these are the two patterns that can possibly happen right there. So it's never different. So it's only these two. You either take the trade like that, or either take the trade like that with the breaker. So quick ID and a quick detail I want to add to the smart money reversal, that it can be sell stops. It can be also an order block. It can also be, let's say, a fair value gap in the market. So you can imagine the market is, let's say, filling in a fair value gap. Like that could also happen. Or it could also be the standard deviation of the initial range. Like that. So it could even be this. But initially, you want to see first the original consolidation. You want to see a consolidation in the market that's quite significant. You want to see the low risk sell in this case, which is giving you, let's say, a daily cycle trade the next day. And you want to see a reaccumulation, redistribution, so where the market starts consolidating once again. Then you want to see the market either take out liquidity, like in this case, sell stops, meet, let's say, one or two standard deviations, fill in a fair value gap, something like that. And that's where you would look at these patterns. Once the market starts moving off from this level, we would fall into, we would create first, obviously, an impulsive with the smart money reversal. We have a strong impulsive. Then we sort of fall into like another small consolidation. This would be a low risk buy. So this could offer you another buy. So you could buy here and you could also buy here. And then maybe also another low risk buy. So you can imagine another impulsive. the market create maybe another daily cycle or something like that. And eventually you want to see the market trade above the original consolidation. So that's the whole idea. This whole thing is basically just giving you a bias. So you would be using this tool to give you a bias of a certain pair. So let's say you would be at this stage once again. So, I just repeat myself, but let's say you would be at this stage, the lower is buy, and you would want to look for buying opportunities until the market trades above the original consolidation. And once it traded above it, above that, the market maker buy model is complete. So, and in just a second, I will show you this on the real chart. I got a bunch of examples of this. It happens so many times. But it's only bias again. So it's giving you a bias, but these executions would happen, let's say, with daily cycle and other lower time frame trading techniques. All right, so guys, just give me a moment because I need to drink some water and I'll be back. Just give me a moment. Okay, guys, sorry about that. So let's continue. Let's look at the 1 hour, I guess. Okay, let's mark this up. I will show you a couple of examples of this because it happens quite a few ways. So it's not many times it's not looking this simple. A lot of times it will be a little bit off. So this would be much longer. So let me show you what I mean about it. So sometimes this would be here. This thing would be only one, like that. See, so sometimes it's just one consolidation, a low risk buy, and then smart money reversal. So it could happen, but sometimes it would be several cycles until we get down here. So there are a couple of ways to do it. Okay, so 1 hour. And this would be one. It's looking good. So if you notice this consolidation in the market. This would be an original consolidation. So we have a consolidation. Below this, we most likely have sell stops. So that's what eventually you want to target. So, you know, when the bias plays out, then these sell stops would be the level you want to have the market trade below. So let's say you took a trade here, you took a trade here. You want to take the trade below the original consolidation. But even though if you're not holding the trade until that level, you know, the bias could be held until we take out the original consolidation. So, you know, I would call this myself the original consolidation. You know, you can just write it here. Like that. And if you notice what happened after the original consolidation, we had this phase, and this was actually, this phase was the low risk buy. So what I mean by that, here we consolidated. Then if you notice, the market offered us a daily cycle here, right? We had an optimal trade entry there, and then it rallied up. So this bit in the market would be the low risk buy, where it, you know, it offers interbank traders a low risk buying opportunity. So this would be low risk buy. And you know, I can even zoom in and show it to you, just a moment. So if anybody does not believe me, you know, you can even look at the key zones. So you can even check it for yourself. How can you identify the low risk buy? All right, so the way you can identify the low risk buy, that, you know, you won't call this low risk buy until we get around here, right? Or to the smart money reversal. So once this bit in the market would offer you, let's say, a daily cycle, which I want to show you in a moment. So let me just mark this up. So that would be the London. So London, and if you check the New York, you're gonna see basically this was a daily cycle. So if you know, now we zoomed into the 15-minute, and you know, basically see the London created a low, created a high, came back, New York is on and offered the buy, right? So technically, we have a low risk buy here. Does it mean? Okay, so when just alone when you have a daily cycle like that, it won't mean you anything too much regarding the market maker buy model or the sell model, you know, same thing, just opposite direction. So this matters once we get around here. So here we had up here. So let me show. So up here we had later, like a reaccumulation, and this top here, this top area was actually the smart money reversal. Then, we came down. See, so basically the same thing. Just, so this is what I'm saying. Sometimes it will be a little bit off, so it may not be this perfect, but the idea is the same. But it's in the end it will be pattern recognition, and your eyes will get used to this over time. So you will notice this a lot of times, and it does happen a lot. So once we would be around this area, you would be able to recall yourself, all right, 3 days ago we had a daily cycle here. 2 days ago we had another daily cycle here, right? So this was also another daily cycle. So if you think about it this way, we had a daily cycle here, we had a daily cycle here. This is what you call the low risk buy. So this would be original consolidation, the low risk buy, another low risk buy. And it's only for the buyers, right? So you want to see the market create this whole idea about the market maker buy model. So we had original consolidation. This would be opposite direction. So this would be low risk sell. Then we would be a smart money reversal, and this is you would look back at history in hindsight, and you could be confirming that, all right, we had a buy here, we had a buy here. That's optimal trade entry, or it could be just a simple order block, something like that. But it's just giving you the bias for these later trades. So if you check, this was a daily cycle. This was also a daily cycle right there. So 7 o'clock, when the kill zone started, that's when we started moving to the upside. And if you check, London was bullish, right? Low of the day, high of the day, retracement there. See, daily cycle. So this would be one low risk buy, this would be another low risk buy. And let's go back to the 1 hour. And then what we have here, we have something that's called the reaccumulation. So in the market maker buy model, this last part before the smart money reversal, before the entire reversal of the model, we have sort of like a accumulation, manipulation, distribution style idea here. So you could even call this in itself accumulation. This is the manipulation. We have the distribution, but in this case you would be looking at it as a reaccumulation after these buys. So this is how the model would go on. This would be a reaccumulation, and it's clearly a consolidation. Above the consolidation, in this case, we had the buy stops. See the buy stops being cleared so impulsively, right there. Okay, guys, just a moment. I will end this recording here. I will cut it and I will send a new link. And if anybody is enjoying what I'm teaching at the moment, then just make sure to rejoin the other link. So I will end this recording now and send a new link. Just give me a second, guys.